So here's a quick concept review. So we know that there are two kinds of options, right? So we've got call options, we've got put options. So first of all, again, what are call options? So an option is a contract, and you can either buy the option, buy the contract, or you could sell the contract by writing an option. Okay, so as a call buyer, and again in level 1, notice we focus a lot on the buying side, right? So call buyer, once you buy a call, you have got the right, not the obligation, but you got a right to buy the underlying asset, like the stock, at the chosen strike price before or on the expiration date. And again, recall that when you buy a call, you have to pay a premium for the right. So it's what we call a debit trade, because money is going out before you make it back, right? So you're paying the premium. So for the call seller, okay, it's the opposite. So when you sell a call, or we call it when you write a call or you short a call, it's the same thing. When you sell a call, what's happening? Now you collect the premium. But by collecting this premium, you are now obligated. You have the obligation to sell the underlying asset, like, you know, sell shares of the stock at the strike price before or on the expiration date to the call buyer. So the call buyer has the right to exercise the option if he or she wants to. But for the call seller, you're obligated. If you're signed, you're obligated to sell the shares at the strike price. Okay. Now, there are basically, in general, two ways to make money from call options. Okay. The first way is to buy low and sell high. Okay. So the first way is to buy a call option at a low price and to sell the same call option at a higher price. This is kind of like trading stocks, right? So you buy low, you sell high. Now we call it buying to open, right? So you buy to open a call option and you then sell to close the call option. So remember, in any trade, you have to always open it and close it. Okay, so in the first approach, you buy to open a call option and you want the call option, the price, the premium to increase so you can sell it at a higher price. Okay, now what would make the premium increase? The main thing would be the asset price or the stock price. So when the stock price goes up, the call option becomes more valuable, the premium goes up as well, right? So that's what we want. We want to do that. So basically, this approach, we use it when we are bullish, when we expect the underlying asset or stock to go up in price. Now remember that as a call buyer, when do we want to buy? We want to buy generally when options are cheap. Again, buy low, sell high. And when are options cheap? Options are cheap when there's low implied volatility, right? Low IV, and we check the IV percentile ranking, as you remember. Okay, so again, remember, buy low and sell high. The second way to make money from call options is to do the opposite. Instead of buying low and selling high, okay, now you sell high and you buy back low, or you sell high and you don't buy back at all, right? If it goes to zero, that's the best case scenario. Okay, so you sell to open a call option. In this case, you're selling to open, and then you're buying to close the call option. So again, in any trade, you have to open it and close it. In this case, you're selling to open at a high price and buying to close at a low price. So when do you use this approach? Well, when you are bearish, okay, when you think the asset is going to go down, or you're neutral, which means you think the asset's going to go nowhere, it's going to like go sideways. Now, what would make the premium of the option go down? What would make the value of the option go down? Well, again, when the asset price goes down, when the stock price goes down, the asset goes down, the option loses value, right? The premium falls, and then you can buy it back at a lower price. It's kind of like short selling in stocks, right? In short selling, you sell high, you buy back low. In this case, it's options. You sell high, you buy back low. And again, when are options high so that you can sell the options? When there's high implied volatility. All right, so all these are the things that you've learned, and it's a quick review of what you've learned basically, right? So it's selling high and buying low. Now remember that options are a decaying asset. right? So over time, the option loses value until at expiration, there's no more time value. There's no more extrinsic value, right? So as a call seller, in the second approach, time works in your favor, because as time passes, the option loses value, and hopefully becomes worthless in the end, or it's worth less, so you can buy it back at a lower price. But for a call buyer, time is working against you, because over time your option is losing value, so you got to ensure that the stock price or the asset price goes up fast enough so that the premium goes up more than the time that you're losing. In other words, the intrinsic value gain must offset the loss of the extrinsic value. And so that's basically on call options. So now let's go on to put options. So again, for put options, you could buy a put or you could sell a put, all right? So as a put buyer, what are you buying, right? So you're buying the right, as a put buyer, you have the right to sell the underlying asset, like a stock, at the predetermined strike price before or on the expiration date. And again, to get this right to sell at the strike price, you pay a premium for this right. Now, as a seller of a put, remember, selling a put means you're writing a put or you're shorting a put. It's the same thing. So as a seller of the put, you collect premium. All right, now you collect a premium, but by collecting a premium, you have now the obligation. You're obligated to buy shares of the underlying asset, like the stock, at the strike price before on the expiration date. So just like the call buyer, the put buyer has the right, but not the obligation, right? As a buyer, you always have the right to exercise your options to demand that you sell at the strike price. But as a seller, you don't have the right, you have the obligation. You're obligated, you've got no choice. You have to buy the shares or buy the asset at the strike price when the option is exercised by the buyer and you are assigned to buy the underlying asset. Okay, so again, similarly for put options, there are two ways of making money. One way is to buy a put and sell it, right? So you buy to open a put and you sell to close the put. Or the second approach is you sell to open a put and you buy to close the put. So again, remember, in any trade, you have to open the trade and close the trade. It's either you buy and sell, or you sell and you buy it back. Okay, so let's go to the first approach. So the first approach is you buy to open a put. So when you buy, you then want to sell to close the put. So in this case, you are hoping to buy low when the price or the premium is low and selling it when the premium is high. So what will cause the premium of the put to go up? The answer would be the asset price. So for the put, it's the opposite. When the asset price or the stock price goes down, the premium or the value of the put goes up. And that's when you sell it to make a profit. So you're buying low and selling high. And when you buy a put, you are bearish on the underlying asset, on the stock. You think the stock's going to go down, so you're bearish. And again, when do you want to buy? You want to buy when it's cheap. Buy low, sell high. So when are options cheap? Similarly to call options, when there's low IV or low implied volatility. So whenever there's low IV, you want to be a buyer. High IV, you want to be a seller. Okay, always remember that in both calls and puts. Now, the second approach would be to sell and buy, right? So you sell to open a put and you buy to close the put. So in this case, you always want to sell high and buy back low, or buy back when it's worthless. You don't have to buy it back. That's the best case scenario, right? So what would cause the premium to fall? All right, so in this case, you want the value of the option, the premium, to fall. What will cause it to fall is when the asset price goes up. So you use this approach when you're bullish on the asset, like the stock. You think the stock's going to go up, or you're neutral. You think the stock's going to go sideways or go up, you use that, right? And so again, you sell high, you buy low. So once again, when are options high? when implied volatility is high. So now again, remember that put options, just like call options, are decaying assets, that over time they lose their value as time passes. That's called time decay. Remember that, right? So as a seller of the put, time decay is in your favor, because as time passes, what happens? The option loses its value. Its premium will keep falling until there's no more extrinsic value left. So that's why as a seller of a put, even if the asset doesn't go up, even if the asset goes sideways, you will still be profitable because of the time value causing the premium to fall and be worthless at the end of the day. But as a put buyer, this time decay is working against you, because again, as time passes, what happens? The premium gets worth less and less. So you have to ensure that the asset price falls, enough so that the intrinsic value gain offsets the loss of the extrinsic value from the time decay, for the time decay, right? So always remember that as a buyer of a put, the only way to make money is if the asset falls fast enough. You have to be very bearish. But as a put seller, you make money as long as the asset is going sideways or going up, right? And again, so that's how puts work.